Okay, good morning and welcome back to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Apologize for this technical difficulties getting into the session this morning, but hopefully you guys are on. It looks like a good number of you are on. We'll make sure that that doesn't happen on Friday again, but a lot to cover here today. Let's go ahead and get started. Before I do, just a disclaimer, what we're going to discuss here today is for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So if we look at the current market, not a lot has changed since we talked on Friday. We've had the subsequent sell-off, the subsequent rally. We've broken above that 285 level. This was the major resistance level that we've been talking about for weeks now. We're just grinding. We continue to grind slightly above, slightly below, slightly above. Looks like we're about to open up a little bit higher here around 293.72, which would certainly retest this relative high that we've had here, which was around 294 or so. If we break above that, we certainly believe that this market will continue to grind higher to that 302 level. That is our base case here for the current market. Now, one of the things I want to point out is that the S&P 500 obviously consists of a lot of different names, but it is fairly concentrated within 5 of the mega cap names, now consisting of almost 25% of the index, just 5 names. That's 1% of the index in terms of number of names, consisting of 25% of the weight of the index. And what this shows us is that really you're just seeing a few stocks drag up the whole market. Because if you look at the NASDAQ 100 index, which is an even more concentrated index where you have the top 5 names that really account for almost 55% of the index, this is the index that's continuing to make relative all-time highs and is trading back near its early February levels, which is pretty astounding. And there are some pretty major resistance level here. We have a gap fill around 229. If the Qs get up to around 229, we certainly think that you might get a small check back in the initial phase. But we believe that this is at least the base case for now, is that for any dips that you get back into that 200, 220 level, these are levels to potentially buy these types of indices. And we expect that this might continue on higher to retest that all-time high, which would be, again, pretty resounding because of the fact that back in January, these indices were trading at a pretty high and what we would call frothy valuation. If the Qs make it back to 235, even where it is right now, it is trading at peak valuation, relative all-time high valuations, because the index is trading at the same price, but the economics and the earnings for the companies, the underlying companies, are certainly not the same. They're significantly lower. So you're trading at substantially higher valuations, but this is the reality that we're currently trading in. This is where the markets are, and we don't necessarily want to fight this current trend. We certainly don't want to fight the Fed, and that's how we're currently positioning. But if you look at the overall market, if you look at the small caps, this is the Russell 2000 index, you clearly see that the market is not as well. The rest of the market, most of the market, is not doing so well. You have the major resistance level around 145. It managed to break back above 125, which certainly puts us in a position to continue to grind higher up until that 145 level, which again goes back to a major support level that has held since October of 2018 or so. This has been a major support level for multiple months now, and we think that we're going to at least get a push back up to that 120 145 level here on small caps, but small caps clearly not participating here in this particular rally. And that is the bifurcation that we see in the markets. We've been talking about this for quite a few weeks now, and it still continues. And the bifurcation is really the opportunity that we see in the markets, because if the markets continue to just grind 0.5% lower, 0.5% lower each day, there's not a lot of opportunity. But if you start looking at sectors and specifically some subsectors, that's really where we still see some quite a bit of movement, and the opportunities that we see in the market are within some of these subsectors. So those are some of the things that we want to take a look at here today. Now, Our base case still remains that the markets are going to continue grinding higher, because despite the signs of exhaustion, we talked about a lot of these here in detail on Friday, despite the clear signs of exhaustion, meaning momentum not confirming new highs, the peak valuations, the disconnect that we're seeing between equities and economics and fundamentals, this certainly is worrying, but there are no signs of a reversal just yet, which reminds us very much of what we saw going into late January, early February, where despite things not looking all all kosher, but you know, there weren't any signs that we had a catalyst to move to the downside. And that's exactly where we currently sit right now, because VIX is back in contango. Front month VIX is trading at, I think, 26 or so, while 3-month VIX is trading at 30. This puts us back in this risk on environment. So we certainly don't see a reason to go out and buy puts just yet. Oil has stabilized. Crude is trading around 25. Brent is down about 4% today, but certainly not seeing the types of volatility and swings that we were seeing even just a few weeks ago. So starting to see signs of stability there, which provides more stability here for the US equity markets as well. High yield, this is the trade that I highlighted on options action here on Friday. Also looking particularly stable, starting to potentially break out to the upside. That's what we're trying to play here. That provides more stability for the market. So all of these things puts us in this risk on environment. Not a lot of movement to the upside, but certainly not looking for short opportunities, except for in very, very specific industries. We're going to talk about some of that. Liquidity continues to fluctuate around that 150, 180 symbol. As of yesterday's close, we were seeing 181 very liquid option symbols, which certainly is a good indicator that stability is, at least for now, here. On Friday, we saw this collapse down to about 150, but it came right back up to 180. So I don't think that there's been any significant changes here in terms of liquidity, which is good. Liquidity is really one of the concerns that we see during a market sell-off. So if we see risk off, if we see some of these risk on indicators turn back to risk off and we see liquidity start to evaporate, that is usually the signal that we're going to be waiting for before we go out and try to buy some puts. For those of you that are asking, is it time to buy puts because puts look relatively cheap? We don't think so at the current moment. Where our expectation right now is still sell premium. This is the environment with VIX at 26. You can generate quite a bit of premium by selling covered calls, selling cash secured puts, selling credit spreads. This is the environment to collect premium, because if and when you get some kind of catalyst that shifts the market's momentum to the downside and liquidity starts to evaporate, puts will be expensive then. But at least at that point, you know it's worth buying puts. You know, from a directional perspective, it makes sense to buy puts. But because they're going to be very expensive, you need premium to do so. Now is the time to collect that premium. We'll take a look at some of the US COVID-19 trends. It certainly is continuing to improve. Here in the US, most of the places around the world, there are a few pockets where it's still getting worse around the world, but overall the trend globally is that it is trending lower and it's trending to a better scenario. Now, there are some cases of second waves. Granted, many of them are fairly isolated. They aren't huge waves, so we haven't seen any economies that open back up that now all of a sudden have to shut back down. That is the downside risk that I see. I'm not saying that that's going to happen, but if we do get that type of event where a major country chooses to open and then reclose their economy because they see a second wave of cases, that I think could be the type of catalyst that could shift the market's risk substantially lower. So that is something we're watching fairly closely, but so far, not a lot of that indication just yet. And then we'll take a look at some of the sectors here that specifically some of the sub-industries that I want to take a look at. Now, we looked at this data here on Friday, and when we looked at this, the number of states that we're still seeing increasing number of cases, I think on Friday was 13 states. Right now, there are only 8. So that's currently continuing to improve. The number of cases, the number of states where the number of cases have remained stable or flat currently is at 27, I believe. This was, I think, maybe 20 or 21 on Friday, and the number of cases where the cases are decreasing are 18 or so. So we continue to see this shift here from number of states that go from this group to this group, and then this group to this group, which again is good. This is the type of trend that we're looking for. This is the type of trend that the markets are, pricing in for at the moment, is that we're going to continue to see this decline at a pretty substantial rate. From Friday to Tuesday, not a large number of days, but we're continuing to see this trend improve. And then I wanted to highlight, something that Elon Musk tweeted last night that I think reflects this country's divide a little bit as far as, getting back to work and getting back out there, because, Elon Musk certainly seems to be very keen on getting the economy up and running and getting his factories to be making Tesla cars. And I think many people who are stuck at home, who want to get back to work, who can't get back to work, may feel the same way, especially if they live in a place where there are fewer cases of the coronavirus. Maybe their work doesn't require them to be in close proximities to other people. They might feel that they're ready to get back to work. So we wanted to take a look at how does the country actually feel if we did just reopen everything and you could go back to work like Elon Musk is trying to do here in his factory for making Tesla cars. So looking at the trends here, a couple of things that we want to point out is that there certainly are indicators that things are starting to pick back up. If we look at retail sales from Morgan Stanley, we've seen a significant impact to that number here in terms of Morgan Stanley's number. And when we look at polls as far as how many people feel comfortable going out to eat, in the next 2 to 5 months, the number of people that have decreased in 2 to 5 months have actually decreased. The people who feel 6 months and higher, 6 months or higher, have actually increased. So this is certainly, people are getting more comfortable with getting out there and potentially start getting back to restaurants. But I will say, even though this data is starting to improve, the actual hard numbers do not look particularly strong. So we don't have a lot of numbers because most states that did open up just opened up a week ago. But as you can see, prior to the reopening versus post the reopening, there isn't a strong uptick that we see like that. We think that this is going to be substantially more gradual, at least looking at the first week's data and looking at how comfortable people really are at getting back out there, even if things are reopening, is that the data isn't particularly strong that you're going to just get this huge spike in activity once states reopen. I think states are being a little optimistic and they want their citizens to get back to work because obviously the economic impact of all of this is significant, but workers don't quite feel comfortable going out there. Certain people certainly don't feel comfortable getting back into a restaurant. So, those are the stumbling blocks that we kind of see that may cause Q2 earnings to look substantially weaker than what we might be anticipating at the current moment. And that is really, in my opinion, the time frame to be looking at, buying puts, going into the end of June, beginning of July, as we start reporting Q2 earnings. That might be some disappointing numbers that we see that is going to have some significant impact on stock prices that could potentially propel us lower. So that's a time frame that I would be looking at if I'm looking at buying puts, but I think it's too early to go out there and buy those August, September puts just right now. So some of the sectors that I want to point us to, discretionary has surprisingly continued to strengthen in this particular environment, given the fact that the consumer spending space, the consumer space is really where we see a huge deterioration in spending. So the fact that discretionary continues to show strength is a bit surprising, but also partially because of some of the things that we've discussed on Options Action, which is the fact that XLY consists of predominantly two stocks, which is Amazon and Home Depot. Amazon obviously being a net beneficiary as a result of the coronavirus, and Home Depot also surprisingly a net beneficiary because as people stay home, they continue to invest in home improvement projects, and Home Depot is one of the stronger stocks. This is why we took a long position in Home Depot last week. We started to take profits on that today, because that stock continues to move higher. It does report earnings here in a few weeks. I do think that there's possibility of Home Depot continuing to move higher, but in this particular market environment, we do want to protect our profits relatively early. So, but discretionary, strong sector, significantly stronger than what we had anticipated here in this particular market environment. But I do want to point you to retail XRT, the retail ETF, also surprisingly strong. And the reason I wanted to point you to retail is because it's trading right around that $38 major resistance level, which is a level that if you go back to the December 2018 lows and back in June, actually this was probably closer to August, that we retested 38 as a low, broke down below it, and looks like now we're about to break back above it. So if we do see that break back above, we could see retail rally back up into that 46 range to the higher end of the spectrum. But certainly at the short run, up until 41, 42, the 200-day moving average. So retail, surprising sector to be strong, but one of the strongest sub-industries right now within the S&P 500. So keep an eye out here for retail. This could be an interesting play here. Financials, on the flip side, very weak. Not as surprising here as far as financials go being weak because of the fact that interest rates are substantially lower or at all-time lows. Financials have not even managed to break back above the December 2018 lows, which is around 22.5. It's now trading at 21.86. So financials extremely weak between 23 and 21. And if we do see a break below 21, we certainly think that the markets can continue to move lower here on financials. But the one thing that surprised us a little bit about financials is the fact that we would think that the interest rate bearing stocks, major banks, regional banks, those are the ones that are going to look the weakest. But the sub industry within the financials that actually look the weakest is actually insurance. Insurance is the one that is still well below that December 2018 low. It is trading closer to the bottom of this particular range. It has continued to make higher or lower highs, and has, certainly the chart setup of what could look like a triangle that's about to fail to the downside. This is one of the few sectors that we have taken some short opportunities in with Schwab, because again, we think that with interest rates being so low, these are going to continue to put very strong downside pressures on these particular stocks. Because for those of you that remember, when Schwab took reduced commissions, their stock only fell about 6% because they don't make a lot of money on commissions. They actually make fairly small amounts of money on transaction costs. They make most of their money on cash. They make most of their money on the interest of the cash sitting in your account. That makes up more than 60–70% of their revenue. So when you have interest rates tumbling, these are going to put strong downside pressures on these particular stocks. And that's why we have taken a rare, I would say, short opportunity in that particular type of name here. So financials is one of the few industries that we're looking at for a potential short. Industrials looking particularly weak as well. Energy also looking particularly weak. We covered energy, on options action on Friday. We thought, Mike and Carter thought you'd get a breakout. I certainly thought this chart looked constructive of a breakout. We still might get it. But we really have to clear this $39 level here. And I think that what you're going to get is a resumption back up to that 42.5 level here, if it does break up higher. But that would be a very short-term momentum play. I don't expect that the strength here in energy is going to stay because of the fundamentals that we currently continue to see in the energy markets. The fundamentals look particularly weak. 30% of the downgrades in debt over the last since March have been in the energy sector. 30%. Energy only makes up 4% of the S&P 500, but 30% of all downgrades come from this particular industry. $290 billion in downgrades. I don't think this is a sector to invest in the long run. I think you might have a short-term momentum play here as oil prices stabilize, but that is it as far as energy. Healthcare. This is obviously a sector that we've been talking about for weeks now, but one thing I want to point out is that healthcare has not made any progress over the last 3 weeks or so. It's really been flat and sideways, and momentum continues to move lower. So despite healthcare being one of the strongest sectors at the moment in the markets, it's starting to rotate a little bit out of healthcare and back into technology. So prior to the sell-off, the strongest sector was technology. And during the rally, from the March 19 lows, healthcare was really the leader here. But that leadership has started to rotate a little bit out of healthcare into technology, as we saw in the Nasdaq 100, the Qs index. That continues to make new highs. It is now pushing its January 2020 price levels. Healthcare certainly got back up there quicker than technology, but since then has really just moved sideways here. So we're starting to see some momentum slow down here within the healthcare space. But one of the indices that I've been talking about for quite some time, which is BioTech, has been making some pretty big moves. I've been talking about 123 for quite some time, and I've been saying sell put spreads below, when the ETF is above 123. We finally got that push to the upside. Now, one of the things I want to point us to is that you have to go back to July of 2015 was the last time the IBB was trading around 123. So for quite a few years, this index has made no progress, as Carter would say. It made a little bit of progress from 2016 to 2018, but certainly did not keep pace with the market, has really traded sideways for multiple years and just started to break out. Now, 133 is a major level for us to keep an eye out for, because if we do get break and retest, this is really one of the sub-industries where we see substantial strength. So IBB BioTech, strong standout in this particular name, in this particular market. So if we're looking for opportunities to go long, these are the sectors, or more importantly, the sub-industries that I would pay attention to here, 133 being a major level. And some names in this particular space, if you look at the strong names like Eli Lilly, similar setup to IBB prior to the breakout, 152 being a fairly strong support level here. You have a 164 all-time high, which if we break back above it, certainly puts it in a very bullish position to continue higher. You've had this consolidation range here between 150 and 165. This type of consolidation is what you want to see after such a strong rally from this 115 low all the way up to 160. You need a little bit of consolidation here before you can continue to move higher. We're starting to get that here in names like Eli Lilly. Bristol Myers, not as strong, but very similar type chart setup. You had that rally from 46 all the way up to 62, about almost a 50% rally. You've had a small consolidation period here, and you might get that breakout here up to that 68 level here in Bristol Myers. So a lot of biotech names have very similar chart patterns here, but I would focus on the ones that are relatively strong, like Eli Lilly and Bristol Myers, and see if you can get a play for a breakout here higher on some of these biotech and pharma stocks. So that is what I wanted to cover with you guys here today. Looks like markets are about to open slightly higher here. 293.91, so a little higher. Looks like we're about to retest these relative all-time highs and make a crack at that 300 level here. But again, this is predominantly what we've been seeing for quite a few weeks now. Markets open up a little higher, opens up a little lower, day in and day out. The market itself, we don't see a lot of big movements, but if you look at sub-industries, focus on the really strong ones, retail coming to life, biotech really starting to come up to life, and then focus on some of the really weak ones like insurance, regional banks. Those are the types of opportunities that we still continue to see in the market. Those are the ones that we've been playing with our daily plays. And also high yield, hoping for that breakout as the Fed starts to buy those ETFs directly starting this particular week. So with that, that's what we wanted to cover with you here today. I hope that you guys find this useful in helping you set up your day and thinking about opportunities and thinking about how to position for your markets and answering some of your questions that you've been sending in, like, is it time to buy puts? We certainly don't think that it's time just yet. So with that, thank you so much. I hope that you guys are able to utilize this every single week for your research. And we hope that you're able to support us here as well to allow us to continue to do this, to provide this type of research and functionality into your OptionsPlay platform by becoming a member, which you can do by using the link here on your screen by going to trade.optionsplay.com/member. And hopefully you'll be able to support us and continue allow us to do this every single week. Thank you so much. We will send out the recording to everyone here in about 30 minutes or so once we finish processing this recording. And we will see you here on our Thursday session here for Thursday afternoon, where we're going to cover optimal expiration dates and strike prices. We're going to talk a little bit about the overarching theme as to how do you go about selecting expiration dates and strike prices, regardless of what strategy you're trading, so that you have this basis that you can utilize across all of your strategies when you're thinking next time, how do you pick the best expiration dates and strike price? So we're going to be doing that on Thursday evening, and then we'll be back Friday morning again to do another market outlook session. Let's see if things change between now and Friday. Not a lot has changed since Friday till now, but let's see, and we'll update you here on Friday. So I hope you guys have a great trading day, and see you guys on Thursday.